AI is the new crypto. AI is the new iPhone. AI is the new internet. It's the thing now that's driving everything. And it's not just like the future, equally distributed. I'm going to talk about AI today and what stocks and what sectors and how best to position for that future. Stick around. Hey everybody, RC Peck here with my weekly email with Fearless Wealth. Now this video is here to help people retire strong and stay retired. I know, most retirement videos about planning and planning and then planning and the 3 questions to ask a planner. But the thing that almost every retirement advisor avoids is talking about performance, like how best to have a stable performance, how to make sure you don't have to go back to work. Most advisors never actually talk about performance. So when I do these weekly videos, what's under the surface is if you want to retire strong and stay retired, the key thing, there's actually 2. 1, you can never take a catastrophic loss, like losing 40, 50, or 60%. And 2, you have to eliminate what is called downside replication. That's when you think you're diversified because you have like 50 equity symbols, but it turns out they all act as one symbol when the market falls 50%. So each week I look at different things, take different approaches to the market to kind of show you what's going on. This week we have to talk about AI. Now it is Thursday right now. Last night after market, Nvidia popped like 3 million percent. Okay, it was more like 25 or 30% after hours because they exceeded their revenue because they're selling AI chips or something like that. It actually doesn't matter specifically, but we will get to it. So what is going on? So what I want to do is get to 2 specific charts and talk about both AI and semiconductors and kind of look at this in a certain way to really understand how to make sure it's part of a portfolio. Okay, so let's just do this. Let's first just move over to a image that I saw on Twitter today. Today is being Thursday after the market closed. So this is the 3-month performance spread between just the S&P 500 and the S&P equal weight. So when the blue line goes up, that means the spread between the S&P 500, which is a market cap weight, and the S&P equal weight, meaning all 500 stocks, I think there's 504 stocks, they're all equally weighted. So when the line gets peaky really to the high, we are looking at periods of great instability, like great instability. December 99, the NASDAQ 4 months later eventually crashed to 83%. October 02, you might not remember, but that was the second bottom in the 50% drop in the S&P in the dot-com crash. And that's when the NASDAQ finished its 83% drop. December 08, that was, let me go from memory here, 3 months after Lehman and 3 months before the market bottomed. And then you got May 20th. That was just after the fastest stock market fall ever. That's when the market fell 35% in 30 calendar days. So here's the takeaway just from this. Things are getting more unstable, not less. That's a theme you're going to hear in this video. Things are more unstable and not less. Now what I want to do is let's look at some price charts here. So this price chart right here is just showing you a few different things. I'm going to tell you what they are. There are 4 different, let's call them indexes, okay? You have the NASDAQ 100, the Qs. You have the total stock market index fund of the US. So just literally it's US Inc. You have all world ex-US. For most people living in the US, think of that as international. And then you have Europe, as in all of Europe and its stock market. So this chart starts at the bottom of the market, October 13th of last year, which was the bottom of the stock market. So from the bottom of the stock market last year to close of market today, Europe's been crushing everything. That's the line at the top, that pink chartreuse, violety, you know what I'm talking about. The one at the top, that's Europe. It is distantly, that's not even a word, it is much farther ahead than anything else. Europe was crushing it after the market fell. And Europe's been going sideways for about 6 weeks now. Just below Europe is the green line, which is all world ex-US, also known as international to most people living in the US. Again, pretty good, beating everything except Europe. And it also has been going just sideways, not crashing, just going sideways. The red line is the NASDAQ 100. It's up 26% since the October low. Everyone, that's legitimate, right? That is 8 months ago, 26% in 8 months, not bad. NASDAQ 100. And then you have the US stock market at the bottom, the blue line, which is up, a little over 12%, which by the way, over 8 months, super legit. But this is from the bottom. And what I often do is look at markets from major, peaks or bottoms. And this was one of those. Now, another one, and I'm going to just change it, was the peak of the market at the beginning of 2022 is when the market stopped going up. That's about 17 months ago. So January 1st, okay, in this case, it's December 30th, 2021, but same difference here. And just notice what's happened over the last 17 months. Now, during the same time period, Europe is still beating everything, right? Just below it, all world ex-US, also known as international, is still beating everything. This case, the blue line, which is the S&P, it's actually above the NASDAQ, right? It's up about, it's actually not up at all. It's down 14%. And the NASDAQ during the exact same time period is down a little, just a little worse. So what I'm showing you is this is instability, right? Now, I showed you from the bottom of the market on October 13th of last year. And I'm showing you right now, I'm calling it January 1st, even though it actually says December 30th on the chart. But so you're seeing 17 months from the peak of the market. So a lot of how you feel depends on what you're looking at. Now, if we just went to the beginning of the year, so let's see if I can get this. I actually didn't remember or put the time in, the actual date. So we are basically almost 5 months through. So let's just go 110 trading days ago. 110 trading days is not right. Oops, hold on, everyone. What I want to do is get to the beginning of the year. So that's January 3rd. Let me just make sure there wasn't a trading day before January 3rd. Let me just do this. Everyone play along with me. So there's December 30th. So this is where the market closed at the end of last year. Now look at this now. This is year-to-date returns. All of a sudden the NASDAQ, which was at the bottom from the other charts, is now at the very top because it just so happens how the calendar fell that the NASDAQ now looks like the place to be. Now, it may be and may take over the world again, but part of what I just want to show you is if you're looking from year to date, if you're looking from where the market bottomed, or if you're looking from where the market stopped going up, it's 3 different stories. The reason I showed you the Twitter picture before we started is because the theme of what's going on in this market right now is instability. You do not, I believe, you do not want to be taking on riskier and riskier investments during a period of great instability. Now, I just showed you that one chart. I can just go back to it from Twitter, just kind of showing you these peaks when the spread between equal weight and market cap weight is at its most extreme, which it is at its most extreme since December of 99. That's simply just showing we're still and accelerating into a period of instability. Like we're not out of it. Okay. So that is one thing I wanted to show, just talking about instability. And look, high five to the NASDAQ, up 27% this calendar year. And again, when we go back and look at the same data differently from the past peak, you can see that, man, Europe was crushing it, and it's now looks like it's got a little correction going on, nothing major. Okay, something else I want to talk about. Let's talk about AI. If you want to be in AI, it's turning out you want to be in a big company, a big, what I'm going to call a tech company. 2 of the biggest companies, though they're not actually considered, one's not actually considered tech. The 2 that are getting most helped by AI seems to be Meta and Nvidia. Now, Nvidia popped big time last night after they had their earnings. It was up 26%, 30%. Doesn't matter whether it was up 26 or 30. It was up a number that I don't think anyone had ever seen before on a company of that size. It added like the size of Costco to it in aftermarket hours. It's impressive. Costco is no small company. What I want to show you here is how much of Nvidia shares were in Kathy Wood's fund. Okay, so this is ARK Holdings, ARKK. She got rid of Nvidia, like completely. The purpley line just shows how many shares, and it goes to 0 in the bottom right. Like she got rid of all of her shares, right? So kind of September 22. Now remember the market, if you remember from my previous slide, the market bottomed. If you can, let me put my cursor here. The market bottomed about right here, right? When she had, I got to figure this out, 700,000 shares, something like that. And then at the market bottom, she started dumping, right? So if Nvidia popping is hurting anyone, it's probably hurting ARK the most. Now, let's look at something here. Look at this screen. These are ETFs. Okay, there's 6 of them on the screen. Okay, 5 of them are AI ETFs. So they have AI in their name, AI powered, AI something, AI and robotics, but they are all AI based ETFs. Okay, except one of them. Now I'm going to tell you which one has no AI in its naming, and it's the black one, meaning the one that's beating the rest of them. So I started this chart. It's at the market bottom of October 13th. So from market bottom of last year to today, the black line is beating all the other AI ETFs. Now, this is a retire strong and how to retire strong and how to stay retired video, right? So this is not about day trading, but what I want to point out to you is you don't want to buy words. You don't want to buy names. Most people are thinking, I got to get something with AI in it, okay? All the lines below the black line, and let me just show this to you differently. I'll just show this to you in a bar chart. So the black line, the black bar, is the semiconductor ETF. Massive, bigger than the other bars, as in like market cap. The other ones have AI in its name, robotics in its name, artificial intelligence in its name, but not the VanEck Semiconductor ETF, SMH. So as how to retire strong is to not get hijacked by the name of what you have. Balanced, blended, income, you'll be okay. Yes, I'm changing my voice to change the energy because we easily get hijacked by the names of our ETFs. And this is a great example of just showing you how the best AI ETF is just simply buying semiconductors. I feel like I was out of my soapbox a little bit there, but it's a really important thing because when people retire and want to retire, they get hijacked by like, give me the blended and balanced fund. Even if it's crashing, give me the income opportunity fund, even if the price is actually falling faster than the dividend. So there is a lot going on in the market. Yields are going crazy. Now the market is pricing in a 50% chance of a quarter point increase for the June FOMC meeting. That's right, you heard me correct. The market itself, based on the CME, Chicago Mercantile Exchange, futures is saying there's a 48.6% chance that in June, the Fed is going to raise rates 0.25%. They were going to do that before, the market had priced in 0.25% to finish at 5.5 before Silicon Valley crashed. And then it got taken off the table. Now it looks like it's back on the table. Here's what I want you to take away, from this. To retire strong and to stay retired is to understand if we're in a period of stability or instability. We are still in a period of instability. I get it. Nvidia, high five, you crushed it. The 2 best S&P stocks this year is Meta, which used to be known as Facebook, and Nvidia. And I believe it's because the market knows that that's what is implementing AI the best. So you can't necessarily look at words and, we're human, we want to do that, but that can really hijack the brain. So the takeaway, I feel like I'm trying to land this plane for the last 20 seconds. The takeaway is we are still in instability. We are getting more instability in the market. Internals are acting more like 1999, 2001, 2002. And yes, I see some of these stocks absolutely skyrocketing. Now, I lived in Silicon Valley for 19 years, so kind of had a front row seat to seeing Companies like, do you remember Sun Microsystems? That peaked at the very top of the dot-com with 10x sales. So I just want you to hear that, 10x sales. Today, Nvidia is at 35 times sales. So these aren't periods of instability. Yes, the market can still go up for another couple months. But where it have a inverted yield curve, steepening of the yield curve is not a good thing for stocks, regardless of what the stock is. Thanks for being in my world. Let me know where you think I got it right, where you think I got it wrong. Again, we are still in a period of instability. This is a period where you want to be protecting. Doesn't mean cash, doesn't mean do nothing. It means looking for opportunities. Thanks, everyone. Leave a comment, subscribe, do the things that YouTube likes because it helps. I appreciate you being in my world and leaving a comment. Take care.